Welcome back, everyone, to today's Explainer. We're your resident public finance advisors, and we are jumping right into the mechanics of how a country actually funds itself. Absolutely. It's a fascinating machine, right? And we're going to pull back the curtain on a topic that usually hides behind the massive, flashy headlines. The exact title of today's Explainer is non-tax revenue.
So let's start by tackling a massive assumption that pretty much everyone makes. Do governments only make money from taxes? When we hear the phrase government revenue, we all instantly think of our personal income tax or the goods and services tax mentioned in our source materials.
Right. It totally feels like taxation is the absolute only tool in the state's toolbox. But actually, scratch that. It's a huge myth. Sure, taxes are a massive, totally essential piece of the puzzle, but a government absolutely does not just survive on traditional taxation alone. Today, we're debunking that completely. We'll see how the state actually operates as a huge service provider, a corporate entity, and even a legal enforcer, all of which generate their own totally distinct streams of income.
Okay, so to ground us, let's look at the broad category of public revenue as a whole, this hidden treasury, so to speak. Yeah, our sources define public revenue as essentially the aggregate collection of all income flowing into the government from everywhere. They have to spend money to maintain law, order, and social welfare, so naturally they have to collect it first. The textbook divides this huge umbrella into two distinct sides: taxes on one side, and what we're focusing on today, the hidden treasury of non-tax revenue, on the other.
Which brings us to the formal definition. Non-tax revenue is public revenue received by government administration, public enterprises, gifts, and rents. Exactly. And the absolutely crucial takeaway here is that this is completely separate from traditional taxes. This is literally the government taking off its tax collector hat and putting on a business owner or service administrator hat. It's a totally different revenue stream flowing into the public treasury, and it plays by entirely different economic rules.
To really lock this in, we need to compare taxes versus fees. According to the sources, a tax, like what Professor Seligman defines, is a compulsory contribution. You are legally bound to pay it. But, and here's the kicker, you do not get any direct proportionate benefit in return.
Right, exactly. You pay your income tax, but the government isn't going to suddenly pave a personalized road right to your driveway. But a fee? A fee is paid in return for certain specific services rendered by the government. It's a direct one-to-one exchange. The government is acting as a service provider here. You pay for a specific action, you receive that specific action.
And what's wild is just the sheer variety of these non-tax sources. Looking at the textbook's classification, there's a surprisingly wide net.
Yeah, we have 7 unique streams listed here. We're talking fees, prices of public goods, special assessments, fines and penalties, all the way to gifts, special levies, and borrowings. It visually anchors just how incredibly diverse the government's income portfolio really is. We won't hit every single line item today, but we are absolutely going to walk through the most fascinating ones right now.
Moving right along, let's look at our first major category: prices of public goods and services, or, as it's often called, commercial revenue. This is where modern governments literally just sell various commodities and services directly to us. It's the state acting as a massive commercial enterprise interacting with citizens in a standard market format.
Think about your normal everyday routine. When you buy a railway ticket to commute to work, or you pay postal charges to mail a package, or even pay an electricity bill, you are voluntarily paying a commercial price for a public utility. This is not a compulsory tax. It's a straightforward commercial transaction. You pay a price, they give you a train ride. It's simple, highly effective, and forms a huge chunk of non-tax revenue for the Treasury.
All right, let's shift gears. We're moving from the government acting as a friendly neighborhood business to its role as a strict administrator and enforcer. Section 2, Administrative Receipts, covering fees, fines, and penalties.
First up are administrative fees. Our sources specifically highlight direct payments for things like an education fee or a registration fee. Yeah, whenever you head to a government office to register a property document, apply for a passport, or pay tuition at a state-run public university, you're paying an administrative fee. You're asking the government to process a highly specific, individualized service just for you. So they charge a fee to cover the administrative labor of providing that tailored service. So yes, unfortunately, even that agonizing wait in line for government paperwork is directly funding the Treasury.
Then we hit the enforcer side of things. There's a brilliant, exact quote from our sources here. The objective of the imposition of fines and penalties is not to earn income, but to discourage the citizens from violating the laws.
I absolutely love that distinction because it perfectly frames what's actually happening. When a traffic cop writes you a monetary fine for running a red light, Their goal isn't to boost the government's profit margin for the quarter. The state is acting as a legal enforcer, not some corporation trying to hit a monthly profit quota by pulling you over. The primary goal is maintaining order, ensuring public safety, and penalizing lawbreaking. It just so happens that this enforcement mechanism mathematically fills up the Treasury.
Okay, let's quickly guide everyone to the remaining, somewhat more unique streams of government revenue: special assessments, gifts, grants, and a few unique financial tools. These cover the rest of the board: special assessment, gifts, grants, and donations, special levy, borrowings, and a genuinely fascinating concept called escheat. Right, so a special assessment is super situational. Like, if a newly built public metro line or highway causes the land value of your specific property to skyrocket, the government might charge a tax based on that massive new benefit. Then you have gifts and grants, which are hugely relied upon during natural crises. Think receiving external grants from foreign governments after a major earthquake or flood. And then escheat. I find this one so interesting. It's simply when the government legally takes full ownership of land or bank accounts left behind by a person who passes away without leaving any legal heirs or a valid will. It really puts into perspective the sheer scope of how funds gather in the Treasury day after day.
Which perfectly sets up a pretty provocative question to leave you all with today.
Absolutely. If the government acts as a commercial business when you take the train, a service provider when you register your car, and a strict legal enforcer when you unfortunately get a speeding ticket, just how much of your daily routine is actually funding public administration?
We've officially shattered the tax-only myth today. The next time you pay a fee, buy a stamp, or pay a toll, you'll know exactly which bucket of the public treasury you're filling up. Thanks for joining us for this explainer, and keep questioning the financial mechanics of the world around you.